Hello, welcome to the Market Carver. I'm Adam Harter, Chief Investment Officer, along with Andrew Thrasher, Charter Market Technician and Portfolio Manager. Thank you so much for joining us here on the last Market Carver of July. We've got a couple of topics for you today. We're going to talk about the municipal bond market and really just a call to awareness for what you own and how it interacts with statements. And then Andrew is going to pick up and talk about the growth outlook after we've seen some trade agreements go through. So let's dive first right into the thrilling world of municipal bonds. Now, I say that tongue-in-cheek, but it always kind of is for me on the bond side. So municipals have been making a little bit more headlines here. There's a lot going on these charts. I'm going to try to simplify it here. So I think most of you know what a municipal bond would be issued from a state or local government, or at least by the sponsorship of a local government, gaining some often some tax benefits. Now, many of these are really, really small issues. So the biggest dollar amounts are going to be issued by the state of Indiana or your bigger states. But by number, there's a lot of really closely held municipal bonds. In fact, some of them are issued and never trade. A bunch of small investors will band together, buy them up, and then hold them until maturity. And why all that matters is these are often picked up by investment funds. And it can always be fuzzy for what the value of those bonds are. Just think about it. If it hasn't traded for 2 or 3 or 4 years, what is reported on that statement may not actually be correct. It may be too high, it may be too low. It could be either one of those. Generally, it runs a little bit higher than if it were to be trading. Now, case in point here is a mutual fund company, Easterly, making the waves here. It was trading. This is the top middle part, maybe where we start here. So it was trading at around $6 on the statement until all of a sudden it fell to about 3. And this isn't picking on this fund company. It's just the way that piece of the industry works. Well, when they had some redemption requests, so some of the individual investors needed to get their money back. So some of those bonds that they owned actually had to trade. And what they found out was that they were worth far less than what they were appraised for. So much so that it took the net asset value down to 3. So certainly a wake-up call to holders of that fund. And this happens across the board in that space. Now, just to be clear here, I'm not talking about most of your what we call high grade, investment grade quality municipal bond funds, but these are the higher yield ones, which have gained in popularity. You can see in that top right panel the growth in assets into these as municipalities want to sponsor investment and see private investment go into their communities. That has swelled. And so it can create this problem of this disconnect, not trading like stocks all throughout the day. There's often a guess. And in the middle bottom panel, you can see there is some uptick of there. I wouldn't say this is a problem for the main stream economy. This isn't something that can bring everything down, but it is an uptick there. And given the importance and popularity that it has gained, it is certainly worth a note of caution for those that do hold them. On the left panel there, you can see one example of an issue here by Buckingham Senior Living, the exact type of single asset you can see backed by a municipal bond. A lot of those trades happen in those orange dots there, around 6 to 12 cents. But a couple of prominent fund managers, Invesco and Nuveen, still hold them at around 36. So a complicated world, and it's one that just we urge caution on, and understanding you may not just have what you think on your statement. So we will put the municipal world behind us and go to the current economy, and Andrew will kind of give you a high-level view on where we stand today.
Thanks, Adam. So a topic that we've discussed throughout the year has obviously been the tariffs and the impact that those have had on both corporate America, consumers, and the growth of the economy. If you remember several weeks ago, we did discuss as we started getting into earnings season, as companies began to tell us how well or how poorly they did in the second quarter, that we were looking to see if there was going to be any kind of read-through or any type of clarity provided from any type of trade deals that we may have, or with their outlook as they begin to get a little bit cloudy on what companies are expecting for the second half of this year. We discussed previously how a lot of companies began to pull back guidance, began to lower expectations as they were not sure as what the impact of tariffs would have. Now we fast forward to today, we're starting to see a little bit of movement in the tariff area with Japan and the EU. Also an announced likely deal of $550 billion investment from Japan in some US projects, as well as we're getting some more economic data on both inflation, consumer confidence, and the labor market. But what stands out and what we want to focus on today is looking at US growth, looking at the economy, the economic portion of what's going on and how it relates to tariffs. So what you can see here, we have the 2025 and 2026 forecasts for GDP. And note the announcement of the reciprocal tariffs. We saw the lower expectations there, and we're not seeing a big bounce back from that. What began to get priced in, the slower growth expectations that were coming out of the tariff announcements. We are seeing a slight uptick, but no longer seeing the same type of recovery as we are in the financial markets, as the stock market has moved back to all-time highs. So it's very interesting to see what the economists are showing as the read-through for what's happening on the economic side, and how it's becoming what they seem to believe a much slower boulder to move as far as what corporations are seeing. As we discussed with Q2 earnings, in fact, 84% of companies have now beat the expectations for Q2 earnings, as the bar was set really, really low because of the lack of clarity in what their numbers would look like as the tariffs began to come out, and then as they begin to get pulled back, and the back and forth that we've seen play out since then. And so it's really interesting to see the response we're seeing from corporate America, from consumers, and then the read through the economy, which appears to be a little bit less impactful of some of the rollback in tariffs or some of the tariff related deals that have become across the news lines. So we continue to always want to be really focused on the financial markets, the things that are really moving portfolios and stocks, but we never want to completely take our eye off the economy and the economic growth and the overall engine that's helping drive both U.S. and international markets higher or lower, depending on the trend and what the data is showing us.
Yeah, well said, Andrew, there. And as we record this here earlier in the week, by the time you watch this, we're going to find out what the Federal Reserve does in its meeting. And so this side of economic data, GDP isn't one of their benchmarks, but the sluggish growth is starting to become more of a concern as it feeds through a weaker labor market. So expect that to be in focus. We don't know what is going to actually happen. It's expected that there'll be no rate cut this time, but it is certainly quite possible that they begin to lay the groundwork for cuts, say, in September. So we'll see. So thank you, Andrew, and thank you to all of you for giving us your time. As always, if we can be of help, please don't hesitate to give us a call, 800-928-4001, or scan the QR code and do so electronically. Thanks again, and have a great weekend.